Accounting for receivables, recognizing and valuing accounts receivable. When we're looking at accounts receivable, there's really three accounting issues that need to be considered: recognizing, valuing, and disposing. And in this video, I'm going to cover the recognizing and valuing aspects. So let's look at recognizing. To recognize means to record something. And so we recognize accounts receivable depending on when we recognize the related revenue. And so in a service organization, we would debit accounts receivable to recognize that receivable whenever we perform a service on account. And for a merchandising company, we would record the accounts receivable when we sell some merchandise on account. And so in both cases, we recognize or debit accounts receivable at the point of that sale on account. Now let's look at the more complicated aspect, the valuing. So our standards tell us that accounts receivable is a current asset because we usually expect to get paid within 1 year or less, and that we need to record our accounts receivable at what we call cash realizable value. Cash realizable value is the amount that we actually expect to receive in cash from everybody that owes us money. So we need to adjust our accounts receivable to reduce it for any amounts that we don't think are collectible. And so there's two methods for recording these uncollectible accounts: the direct write-off method and the allowance method. So first, let's look at the direct write-off method. Under the direct write-off method, you record bad debt expense when a specific uncollectible account is identified. So you wait until you've identified a certain customer that you do not think is ever going to pay you, and then you reduce accounts receivable directly for that amount. So here's an example. Abbott uses the direct write-off method to account for uncollectible accounts. So we're going to journalize the adjusting entry on December 31, assuming that Abbott determines that R. Frank, a certain customer, their $2,400 balance is uncollectible. So what we're going to do is on December 31, when we identify that certain customer, we would debit bad debt expense and credit accounts receivable. Bad debt expense is an expense account, and then we're reducing accounts receivable because we don't expect to receive that money. So under the direct write-off method, we are waiting until we've identified a specific account, and then we're writing it off. And because of that, the direct write-off method is not a desirable way to record uncollectible accounts. It does not match the revenues with the related bad debt expense into the same period. They're going to happen at different points in time and in different periods of financial reporting. Also, the direct write-off method does not show the investors and creditors what is the company's expected cash realizable value of their accounts receivable. And so for that reason, the direct write-off method, although it is used by some companies, is not GAAP. It does not apply and follow these accounting standards. Instead, they should use the allowance method. And the allowance method is a two-stage process. The first stage is to determine the estimate, and we look at how much we expect to not collect on the receivables. And then at a later point in time, they'll write off specific accounts that have been identified as not being collectible. So let's look more at the first step. We're going to estimate the amount that will not be collected and make what we call an allowance. And there's two primary ways that companies make these estimates, either based on a percentage of sales or based on a percentage of receivables. So let's look at an example of step 1, making the estimate. The ledger of Costello Company at the end of the year shows an accounts receivable balance of $132,000, sales revenue of $859,000, and sales returns and allowances of $31,000. If the allowance for doubtful accounts currently has a credit balance of $3,000 in the trial balance, we're going to journalize the adjusting entry of December 31 for bad debts, and we're going to assume that they are 3% of net sales. So right now we're going to do the percentage of sales method, and the company expects not to collect on 3% of their net sales. So the first thing we need to do is calculate our net sales by taking our sales minus the sales returns, and we determine that our net sales then are $828,000. Then we can calculate that if we expect not to receive 3% of that, that comes out to $24,840. And so under the allowance method, using the percentage of sales to calculate the allowance, we would debit bad debt expense and credit allowance for doubtful accounts for the $24,840. So again, the bad debt expense is an expense account, and now we have an account called the allowance for doubtful accounts, which is a contra asset. It's a contra asset because it increases with a credit balance, but it's going to sit right below our accounts receivable in our assets section, so that it's going to offset the $132,000 of accounts receivable by that $24,000 that we expect not to collect, and now our investors and creditors can see the actual amount of cash we expect to get from our accounts receivable. And so when we're doing the percentage of sales method, we're looking at just the sales for the current year, because remember, your sales account is a temporary account, which means it starts at 0 at the beginning of the year and it grows all year long. So when you're using the percentage of sales method, what you're doing is you're calculating the current year's bad debt expense and allowance. Now let's look at the same company, but instead we're going to do the estimate based on the percentage of receivables method. So here we're going to take the accounts receivable balance times the 12% that they expect not to collect, and we're going to determine that our total allowance then is $15,840. So when we're looking at the percentage of receivables method, you're actually calculating what the total allowance should be. So we need to go back and look at our problem, and we see here that currently that account has a credit balance of $3,000. So we're starting with a $3,000 balance in that account, and we've determined then that our total allowance needs to be $15,840. So the amount of our journal entry then is only going to be the $12,840. So we're going to debit bad debt expense and credit the allowance for the $12,840, so that our account ends up with a total allowance of the $15,840. Again, we're using the same accounts here, it's just the amounts are different. And because accounts receivable represents all amounts owed to us, either people from sales from this year, it could be sales from last year, it could be sales from 2 years ago. So when we're looking at the accounts receivable balance and using that to determine our allowance, we're actually figuring out what our allowance ending balance should be, and then we adjust to figure out what our current year bad debt expense is. So again, a company will choose one of the two methods. A lot of time in the problems assignments, they have you do both, but in reality, a company would only choose one of those two methods to figure out what their estimate is for that allowance for doubtful accounts. Now we can look at the next step, which is the write-off. So write-off is going to occur at a later point in time when we identify a specific account that we're not going to collect. In step 1, we're doing an overall estimate in total, looking at all of our receivables or all of our sales. In step 2, we're identifying a specific account and writing off that person that owes us money. And so it doesn't matter which method they use to make their estimate, the journal entry for the write-off ends up being the same. Okay, so if we go back and we look at our example that we had before, now we have on March 3rd, Abbott determines that R. Frank's $2,400 balance is uncollectible. We've identified a specific account. So now we're going to debit the allowance for doubtful accounts and credit accounts receivable. So what we're doing here is we're reducing our allowance, and at the same time we're reducing our accounts receivable for that specific account that we are writing off. So in summary, when we are doing our valuation of our accounts receivable, there's two methods to do that valuation. The first one is the direct write-off, where you only record bad debt expense when you've identified a specific customer, and then you directly reduce accounts receivable. And remember that direct write-off method is not GAAP, but that doesn't mean you don't need to know how to do it. You do need to know how to do it. And then the second method is the allowance method, which has the two-step process. Step 1, you do an estimate of the amount that is going to go in the allowance. And then in step 2, you reduce that allowance for any specific accounts that you identify that need to be written off. And because of this two-step method, we are achieving our matching goal of recording bad debt expense in the same period as the related sales. So that method is GAAP, and it is the method that companies should be using. And so that is everything on the valuing and the recognizing of the accounts receivable.